Hi, I'm Jo from Kepler Trust Intelligence, and today I'm joined by Richard Staveley, manager of Rockwood Strategic, to talk about the themes shaping his portfolio. So Richard, many thanks for joining us today.
Well, great to see you again, Jo.
Thank you. So I'd like to start off with the bigger picture and perhaps your thoughts on where you see the UK small cap recovery cycle sitting at the moment.
Right, okay. Well, the truth is that in the last 5 years to the end of June, the AIM market's actually down 38%. Now, FTSE small cap index, which is on the main market, it's up a paltry 3.4%. That's over 5 years. And this compares to the FTSE all share, which is dominated by large caps, are up 68%. Which is actually a pretty decent return for UK equities in the last 5 years. So small cap has massively lagged large. And I think we have to agree probably that there are 2 or 3 key reasons for that. The first has been the interest rate environment during those 5 years, which had been very low, ramped up at the start of 5 years ago to high, to nearly 5%, and then remained pretty high ever since. And that's had a big dampening effect on the attractions of small cap, which are typically perceived to be a higher risk asset class. I think secondly, I'm afraid our Chancellor, whilst we record this video of Mrs. Reeves, has cut off AIM's legs from the knees down by reducing the tax breaks available to AIM shares, and that's clearly, I think, the reason why the AIM market has massively underperformed the poor performance even of small cap. I think thirdly, the data is totally evident in that flows have been almost consistently negative in terms of the UK market, money coming out of UK equities and indeed small companies for the last number of years. What this does mean is that there is a material opportunity for recovery and a material opportunity for mean reversion versus the long-term returns.
And coming back to the point you just made about the disparity returns between small and large caps, does that create an opportunity for an active manager such as yourself?
Well, I think it does, because if you take the long-term performance of small companies, the London Business School goes back to 1955 in terms of its long-term series. The bottom 2% of the market on average, when compounded since that period, would have taken £1,000 to be worth £29.1 million. Which sounds extraordinary. Obviously, large caps have done well as well. They would have compounded up to about £1.9 million, which is great too. But even if you take the last 20 years, UK small companies have outperformed UK large companies. So after a period of deep underperformance, the mean reversion effect, it could be very material. And in previous periods where small cap have started to perform, it's been quite sharp correction. The long-term premium in terms of valuations for small cap over large cap is 6%. So on average, small companies, because they grow faster and can generate higher returns, it's been about 6%. It's currently sitting at about 15% discount. So there's a clear opportunity for that discount to unwind, go back to historic norms and catch up the performance and probably accelerate forwards. If we take Rockwood itself, and I think this is probably the most important point I make on this whole video, is you take AIM minus 38 in the last 5 years. We're up to the end of June 107% in the last 5 years, demonstrating without any shadow of a doubt that a stock picking approach or in a concentrated portfolio can navigate this environment and generate really attractive returns irrespective of the backdrop for UK smaller companies. That said, interest rates, if they do start falling, I think will become a big driver of small cap outperformance. And that's what everyone should be looking for or trying to anticipate, remembering that if they try and leave it too late, they will miss possibly the first big moves in UK smallers. The inflation backdrop is being supportive, actually. Underlying in the UK economy, it's pretty soggy. We're not economy running hot at the moment, and I think this year's market performance has been essentially hamstrung by the conflict in Iran, which has clearly worried, quite rightly, everybody that there could be some secondary inflationary effects which get sticky in the economy, and thus the Bank of England's being cautious about cutting rates. But the moment that changes, it's the game is afoot. I would suggest.
So I think in summary, despite some challenges, a pretty compelling investment case for UK small.
For the medium term, no doubt, yeah.
So moving on to portfolio activity next, could you perhaps take us through some of the recent changes that you've made?
Okay, well, two have been forced upon me, but they're good news in that we've had two takeover bids of late. So Treat PLC was bid for at a 48% premium to the share price. We'll lock in a 44.5% IRR on that investment, which we're very pleased about. And Vanel has had a 58% premium takeover offer. We'll lock in a lower IRR. That bid took a bit longer than we hoped and been kind of agitating behind the scenes for, but we'll lock in an IRR of 12.5% for Vanel, which is perfectly respectable given the company's had quite a difficult time of late in the last 2 to 3 years. So that's all positive. And I think does highlight that overseas buyers are spotting the value in UK small caps if domestic fund allocators aren't. So I think that's quite important. Secondly, I may, this could get quite emotional. I may burst into tears, but we have actually realized our investment in Filtronic, which has been a fantastic investment for Rockwood. And let's face it, they don't come along like this very often. We'll have realized a 225% IRR in Filtronic, which we've held for just over 3 years, made about 13 times our money on average from in to averaging up to averaging out over the last sort of 9 months or so. So that's a fantastic exit for us. I think also in that respect, I think it's most important that it sort of flags the fact that you can have multi-baggers in this approach, and that we can make many more times than 100%, which is our target returns from each investment, and that will offset the things that we get wrong. I think thirdly, in line with our very differentiated approach, we've just refinanced Videndum, which got down to 10 million market cap. I mean, there is a few houses in London worth more than the market cap of Videndum before their refinance. But us, alongside a number of other significant investors, have rescued that business and put it on a stable footing now for the operational turnaround that will happen under the management team over the next 2 to 3 years. And we're very excited about that recovery opportunity over that time horizon. Now, we've also been adding some new stocks. So 2 new companies in the domestic economy linked to the housing market and housing activity. The first is a company called Stelrad, which is a market leader. It's actually has about 50% market share for radiators in the UK. As we sit here in the middle of a heat wave, I'm not becoming a massive contrarian investor, but Stelrad, about 50% of its businesses in the UK, 50% in Europe, very strong market positions and a significant recovery opportunity in their profitability over the next few years. And we've also, this is news flash in this video for all those listening in, we have also purchased Marshalls PLC, which is also a market leader in the UK in landscaping, both for domestic and local authority government schemes, as well as new build housing and refurbishment of housing, and also a roofing leader in the UK with the Marley brand, and also particularly strong position they have in solar panels into roofing. And again, that business is a new stock we've bought. I think the only other thing that's worthy of investors knowing is we've continued to build our stakes in 2 of our highest conviction positions, one being Capita PLC, where we're now through 5% of the equity in Capita, and also Focusrite PLC, which makes audio interfaces for the content creation market and the music industry. And we've also gone through 5% there.
And looking at the pipeline more broadly, Where are you finding the most compelling value opportunities? Is it perhaps focused on a couple of sectors, or is it purely just about bottom-up stock picking?
Well, 95% of the time, it really has been, since I've been running Rockwood, completely stock picking. It's been a total potpourri, or it's a total mix of where the ideas have come from, but are very similar characteristics in that they have depressed profitability, depressed valuations, depressed share prices, with the opportunities for change either through operational management or strategic initiatives. That said, at the moment, we are, as I just mentioned, seeing a number of ideas emerge linked to the broader housing economy, which, let's face it, is a depressed industry at the moment in terms of activity. Very depressed confidence with the UK consumer. The desire to spend money is actually very low. Savings ratio very high, and those companies linked to that sector are now on very low valuations, on very low levels of profitability, and we've bought a couple. And we're in the process of buying a couple more, but we're going to keep those under wraps for now. That said, across the portfolio, there's quite a wide range of opportunities that we see, still significant recovery potential. That in financial services, both Vanquis Banking Group, the old Provident Financial, and Funding Circle, their recoveries are in full swing. So we've made very good returns in both so far, but we think that they are really motoring this year. I think in addition to financial services, we've got self-help recovery situations ongoing where we've been pretty active, got engaged, changed some board positions at both M&C Saatchi and STV Group. But I'd probably throw Videndum in there as well, because that has media and industry exposure. So all of those three are quite interesting. And then you take something like Kooth, which is our investment in the mental health services industry, where it is a digital provider enabling counsellors to help young people with their issues in a kind of an initially anonymous fashion. And they're doing that. They're market leader in the UK, but they're also the provider of that service in California. And in terms of just opportunity, that's on one-time sales. We're expecting California to make it clear that they're going to be using the service for multi-years going forward. They won Michigan as another state. They're in New Jersey. They're just getting going, this company, and it's really, really undervalued. It's huge cash balance, highly profitable, and that, and again, just straight stock picking in that regard.
And coming back to the likes of Filtronic, which has outperformed even the mighty Nvidia over the last 5 years, I guess it's a nice problem to have, but how do you decide how long to run your winners for?
Oh, running winners. Yeah, it's not easy. The main reason is because all investors, including myself, are exposed to all these sort of psychological biases and behavioral issues to do with our weird human brains and the dispassionate requirements that you need to be an effective investor. So, when something's done really well, you first become overconfident that you think you know everything, you're great. There's a thing called the endowment effect, which some people call ownership bias, where you value the thing that you own more than things that you don't own, even if they're completely identical. It's just the ownership makes you think it's worth more than it is. I think there's also a thing called attribution bias, where you attribute your successes to yourself, but when things go wrong, you attribute it to external events outside your control. So with the Filtronic, it's all about what we thought, and nothing about what's happening externally. And then the most difficult one linked to running winners is called the disposition effect, where investors are disposed most readily to sell their winners early, and to hang on to their losers because they don't like to sort of accept that they've made a loss. So we're pleased that we ran this from 12p, and I think the highest we sold some shares were £4.50. So we did probably run it. Now, how do we do that? So firstly, you have your original thesis for why you invested in the company, with its valuation target and what you expect to happen to earnings over the next few years. And then you're able to then update your thesis for any fundamental changes that occur in subsequent periods. And at Filtronic, a number of things happened that weren't in our original thesis. We did expect them to start winning some contracts in space, but we didn't expect SpaceX to announce a strategic alliance with Filtronic and give them massive contracts the sizes that they have. So we had to update for that. I think secondly, we probably didn't know as much about SpaceX as everyone in the world does now. And I think, particularly if you read Walter Isaacson's biography of Musk, to really understand the pace at which this man is moving. I mean, it's just phenomenal. Filtronic themselves refer to old space and new space, and old space moving quite a slow pace in terms of development and their projects. And new space, meaning Bezos and Musk moving up space. So that we had to update our model for how quickly he was putting up his satellites and moving on his business model. And then they've also won new clients as well. So we were able to increase the valuation expectations for that. Now, despite all of that, at some point, Filtronic did go through our valuation expectations for the business and its intrinsic value. And then at that point, it can either be a sort of, a computer says no type approach to the investment, or you can understand that momentum is a really important factor in markets, and understanding what momentum is in a stock and the various characteristics of momentum, which we'll then continue to systematically analyze. So there's three of those. Firstly, earnings momentum. The second is price momentum, like share price momentum. And the third is catalyst momentum, as we expected catalysts. And we could see when it had gone through our valuation target that there was going to be ongoing earnings momentum. The share price technicals were very, very positive, suggesting there wasn't about to be any immediate collapse or massive drawdown in the shares. And we were kind of, because of our fundamental understanding of the business, we're just aware there'd be further good news coming out. So we were reluctant to sort of cut it early. Pulling all that together, it is truly the case that I've now been running UK smaller company funds since 2001, and experience does matter in terms of knowing that. And I think I have evolved and hopefully improved over the years, and I think it's that level of experience which you put to bear when just trying to decide how do you exit. Now, there's no doubt in my mind that Filtronic could probably go on and probably will go on to a higher share price than we are, but we can't really see the valuation support for that. We can see a lot of the good stuff they'll probably announce in the next 12 months. We think is already reflected in the valuation of the shares. Now they may move around, but at some point you can't. We're moving into the realms of speculation rather than soundly grounded investment cases for why we should deploy a lot of Rockwood shareholders' money in the stock.
That's, I think, a really interesting insight to how much Filtronic has evolved since you've owned it. So, yeah, thank you for that one. So, looking at the strategy more generally, you mentioned earlier a couple of takeovers that you've had in the portfolio. We've obviously seen quite a lot of M&A activity. Is that perhaps shrinking the pool of available opportunities for you in the UK small cap sector?
Well, it is. It is shrinking it. My former colleague and outstanding investor, Hugh Sargent, recently posted that he worked out at the current rate of takeovers versus the lack of IPOs, that there wouldn't be any shares at all left on the UK stock market in 7 years,
right,
which is kind of depressing. But like with all sort of spreadsheet analysis, the reality will probably be different from what it's telling you on the spreadsheet. However, the pool is still significant. So on the AIM market, there are about 600 stocks that are capitalized less than 250 million. And on the main market, there are another 250 stocks that are capitalized under 250 million. So that's a big pool to choose from. I think with regards to Rockwood, it's worth reminding people that we currently have 25 holdings. So we're only looking to buy, on average, 4 to 5 new holdings a year. That sort of tempo could be down as low as 2 to 3 if we can't find the right things. So can we find sort of 4 great ideas out of those sort of 800 stocks per year, I think we can, and probably for the foreseeable future. That said, the board of Rockwood Strategic have updated the investment policy, which was quite kind of limiting when it was first set out, that the market cap that we invest in predominantly should be under 250 million market cap. And we've just updated it because with inflation and market moves and market structural changes, so that the majority of stocks need to be purchased below 250 million market cap. So we're sticking below 250 million mostly, but that move from predominant to majority gives us a bit more flexibility and probably increases the universe a tad too.
So I had a couple of questions around scale. Rockwood's NAV has increased by over 200% in the last 3 years. So I guess, firstly, can the strategy be as effective at that scale? And secondly, what does that mean for your overall investment capacity?
Okay, thanks, Jay. So well, we definitely think it can still be effective at the current size. We're not at capacity yet. And we're actually, we're delighted that the fund has grown to where it is, because it means that the underlying investment vehicle is more liquid itself for our shareholders to buy and sell if they want to do that. And secondly, we've got a lot more capital now to deploy into this depressed market. So it's great. We do assessing capacity is a mix of both science and art. And at the moment, we think that the capacity is likely to be somewhere between 250 million and maybe 350 million, but probably not that far. We'll see in time. So we've got a bit of a way to go to get to 250. When we do get there, the board haven't made any decisions on this yet, but you would expect the sorts of things to be under discussion would be that we soft close when we hit 250 million, meaning that the issuance program that we're currently undertaking to issue new shares to investors that want to put money into the strategy would stop, and would just allow people, if people want to buy, have to buy off sellers. And we'd probably have a period of kind of monitoring, taking stock, seeing how it works with 250 million for a bit. And then presumably, or hopefully, performance would continue, which case we're going to get bigger and maybe we get up to sort of 300 and roughly there. And then I suspect what the board will do will a combination of, or one of, the following, either sort of ad hoc tender offers to return money to shareholders, ad hoc or ongoing buybacks to buy back shares of those that want to sell, rather than letting them go to other shareholders and retiring that equity. And maybe we could have some form of dividend policy out of capital to just keep returning. I think it's worth investors and shareholders understanding, though, that with a concentrated in a liquid portfolio, it's not quite the same as some other strategies. So we're going to have to use common sense, and we're going to have to, when we return money, it's likely to be linked to realizations when there's a liquidity event within the portfolio, and that kind of thing.
Right, and one final question for you, if I may. As we know, private equity's had a difficult few years, but do you think Rockwood offers a good option in terms of a private market style approach, but in public markets?
Yes, so there are a number of similarities between private equity and the way Rockwood goes about doing things. There are also some pretty important differences as well. Maybe we do those first, if I can remember them all. Firstly, private equity control the companies they invest in. They typically own 100% or definitely a majority controlling stake. We can only ever own a minority influential stake, and that's what we target, but it'll only be a minority position. So we can't force change alone. Obviously, if we make good arguments to other shareholders about what change should be and they support us, we can get to a position where we influence. Secondly, in that regard, private equity will put their guys on the board and be able to control that. In our case, we typically either propose candidates when they're looking for new NEDs for boards that we're invested in, or we request a board position ourselves if we've got up to a particular stake. And of the 25 holdings, just over half, we've got a board member who's either we proposed or it represents us on the board. I think private equity is quite concentrated. I think most private equity funds have about 10 to 15 holdings. We've got the majority of the capital in the top 10 of Rockwood, but we do have 25 holdings, so a bit more diversified, but not. Private equity funds typically have a time horizon of 3 to 5 years. These days, it's more than 5 years plus, it appears. Rockwood's time horizon is 3 to 5 years, so that's similar. Now, there are quite a few types of private equity these days in terms of, the guys that, are buying the companies of tomorrow. The old style private equity, which was very much focused on free cash flow and businesses that could do, guess what, our catchphrase, operational strategic and or management initiatives or change to unlock and recover, create shareholder value. That's the style that we undertake. So that's a big similarity too. And I think probably the most important thing when people are considering Rockwood relative to other small companies funds, which we think is a completely legitimate thing to be doing, is that they are often benchmarked against the Deutsche Numis Index, the performance of a benchmark made up of different stocks. We don't look at the benchmark whatsoever. We are absolute return focused, like a private equity fund is. We target each investment has to have an investment case where it can at least double in value over 3 to 5 years, which would produce, if that works out, at least 15% return on average per year over a 5-year holding period. And that's kind of how private equity thinks. So we do have a lot of similarities. I think what's different is definitely for the mainstream private equity funds that are private, not the listed sector, but the private. So, those you give them your money or you commit your money and they request it and they give you it back when they decide. Obviously with Rockwood, you can buy and sell the shares, and be a shareholder for hopefully a long time. But when you want to change your circumstances change, you can do something with with your shares in Rockwood. And also, I think it's probably relevant that the private equity guys, which is a bit of a problem for some of them at the moment, their liquidity when they're trying to get their exits is essentially to each other these days. And it used to be the IPO market, but that's not only difficult altogether for private equity now, but also I think investors are a lot more wary of private equity listing stocks on the stock market. If we take Rockwood now, we can clearly sell to trade buyers our positions when they get bid for, like some of the ones we mentioned earlier, or to private equity, where a couple of our holdings in the last few years have gone to private equity. But also we can sell to the stock market, which we've done in the instance of Filtronic more recently, or Galliford Try last year, where we're just selling to other fund managers. So I suspect our liquidity profile is a bit better than private equity, but definitely quite a few similarities too.
Fantastic. Well, that's a perfect note, I think, on which to finish. So many thanks for your time today.
Well, thank you, Joe, very much.
You can visit the Rockwood website to find out more information about the Trust, and you'll also find our latest research note on the Kepler Trust Intelligence website. Many thanks for watching, and we hope you join us again soon.